A massive silver shortage may be forming, not because a headline told you so, and not because social media suddenly rediscovered silver. It's not driven by a few stackers posting photos of empty shelves or short-term hype cycles that come and go. If a shortage is forming, it's happening for a much more important reason. The visible price of silver and the real-world availability of silver do not always move together. Price can remain calm, even stable, while the underlying physical market begins to tighten in ways most people never notice. And when those two realities start to separate, when price says one thing but availability says another, that's when smart money begins to pay attention. This is the part most people miss, because they focus only on what's visible. Most people look at the chart. They watch price movements, trends, and headlines, but smart money looks deeper. They look at the structure behind the market, the mechanisms that quietly determine how supply and demand actually function. They watch inventories closely, tracking how much metal is truly available versus what is simply reported. They observe delivery behavior, noticing who is taking physical silver versus who is rolling contracts forward. They pay attention to refining bottlenecks, where delays can signal stress in the system. They monitor industrial demand, where steady consumption quietly pulls metal out of circulation without dramatic headlines. They analyze who is buying, who is standing for delivery, who is rolling their positions, and who might be scrambling behind the scenes. Just as importantly, they notice who continues to act as if everything is normal, even as the underlying plumbing of the market grows tighter. And that is exactly why this moment matters. Because when pressure builds beneath the surface, it rarely announces itself early. It shows up quietly, in the data, in behavior, and in subtle shifts that only careful observers recognize. Because if a silver shortage is truly beginning to form, it probably won't announce itself with a clean, obvious headline that says, "Attention, shortage starts today." That's not how these things happen. They start quietly. They start in the background. They start with small distortions that most people dismiss. A premium that doesn't fall when spot falls. A delivery month that acts a little too tight. A warehouse trend that doesn't feel catastrophic on day one, but keeps leaning in the wrong direction. A physical bid that stays stubbornly firm. A market where paper says one thing and the real world says another. That's when the game changes. And if you wait until every mainstream outlet agrees that the shortage is real, the repricing is usually already underway. Welcome to the Macro Mirror. In this video, we're going to break down what a true silver shortage actually looks like, why the futures price can stay calm while physical tightness builds underneath, what smart money is watching right now, and the exact signals that matter most if you want to separate real stress from internet noise. And stay with me to the end, because I'm going to give you the 5 signals that smart money watches before the public catches on. And those signals matter far more than today's candle, today's tweet, or today's panic headline. If you want macro analysis without the fluff, subscribe to the Macro Mirror. Now let's strip away the noise and get to the real issue. When most people hear the word shortage, they imagine something dramatic. They imagine empty shelves. They imagine dealers with no product. They imagine a viral moment. They imagine a total breakdown where nobody can get anything, anywhere, at any price. But that is usually the final stage. That is not the beginning. The beginning of a shortage is much more subtle. It doesn't look like nothing available. It looks like available, but not as easily, not as cheaply, and not as comfortably as before. That distinction matters because shortages are not binary. They are not simply on or off. A real shortage develops in layers. First, the system loses flexibility, then it loses buffer, then it loses speed, then it loses confidence, and only after that do people start using the word shortage. This is the first thing smart money understands. They do not wait for the loudest symptom. They watch for the loss of elasticity. Because healthy markets absorb shocks, tight markets amplify them. A healthy silver market can handle bursts of demand, temporary refinery delays, regional dislocations, shipping slowdowns, and delivery spikes without sounding the alarm. A tight silver market cannot. In a tight market, small disruptions start having oversized consequences. A modest increase in industrial demand matters more. A refinery bottleneck matters more. A delayed shipment matters more. A sudden coin rush matters more. A surge in standing for delivery matters more. Why? Because tight markets have less slack. And a market with less slack becomes more vulnerable to volatility, dislocation, and price repricing. So if you want to understand whether a silver shortage may be forming, don't start by asking, are shelves empty? Start by asking, is the system becoming less resilient? That is a much smarter question. And it leads to the second truth most people miss. Silver is not just a metal. It is a chain of mining, transport, refining, fabrication, vaulting, financing, hedging, delivery, industrial procurement, and retail distribution. And shortages don't have to begin at the mine. They can begin anywhere in that chain. You can have enough metal in theory and still have a shortage in practice. If the right form is unavailable, that matters. If the metal is in the wrong location, that matters. If industrial buyers need immediate delivery but available stock is not accessible on the timeline required, that matters. If financing conditions tighten and inventory holders stop releasing metal, that matters. This is why simplistic thinking fails in commodity markets. Markets are not only about total quantity, they are about usable quantity, accessible quantity, deliverable quantity, and timely quantity. In other words, a shortage can begin long before the public recognizes it, because the public tends to think in headlines while smart money thinks in logistics. And silver, more than most people realize, is a logistics story. Now let's talk about why silver is especially vulnerable to this kind of hidden stress. Because silver is not just another commodity, it sits in a very unusual position. It is both a monetary metal and an industrial metal. That dual identity is what makes it so fascinating and so explosive. On one side, silver has a long history as money, store of value, inflation hedge, and crisis asset. On the other side, silver is consumed in the real economy. It is used in solar applications, electronics, power systems, contacts, switches, medical uses, military systems, communication infrastructure, and advanced manufacturing. That means silver can be pulled by two different engines at the same time, financial demand and industrial demand. And those two engines do not always move in sync. Sometimes financial demand is hot while industrial demand cools. Sometimes industrial demand is strong while investor sentiment is weak. Sometimes both hit together, and when both hit together, the market gets uncomfortable very quickly. Because silver is not a giant market. That is one of the most underappreciated facts in the entire story. Silver feels huge to the average viewer because it is globally known, heavily traded, and constantly quoted. But the amount of investable and deliverable silver that can truly move the market at the margin is much smaller than most people assume. And small markets become unstable faster. That's why silver can look sleepy for long periods and then turn violent very quickly. Now add another layer. Most silver is not mined as a primary product. It is produced as a byproduct of mining other metals: copper, lead, zinc, gold, and others. That means silver supply does not respond cleanly to silver price alone. That is huge, because when people say, well, if silver gets more expensive, miners will just produce more, they're assuming supply is highly responsive. But in silver, that response is often slower and less direct than expected. If a copper mine produces silver as a byproduct, the operator's main decision is driven by copper economics, not silver. If permitting is slow, projects are delayed. If grades decline, output gets pressured. If energy costs rise, if labor costs rise, if financing tightens, if political risk increases, output gets pressured. So silver can face a situation where demand is dynamic, but supply response is stubborn. That is exactly the kind of setup that can create hidden tightness. And not all silver is equally available. Some is locked into industrial pipelines. Some is held long-term. Some is tied up in investment bars and coins. Some is sitting in vault systems, but not necessarily eager to move at current prices. This is where the story gets serious, because a commodity market can look adequately supplied on paper while becoming increasingly constrained in practice. And that is often how stress begins, not with a dramatic absence, but with a quiet refusal. A refusal of holders to sell at current price. A refusal of inventory to mobilize on the timeline demanded. A refusal of the market to behave as loosely as the quote screen suggests. That is what smart money looks for. Not just supply, but available supply. Not just ounces, but responsive ounces. Not just inventory, but inventory that can actually come loose without a much higher bid. That is a completely different lens. Now we need to address the biggest source of confusion in the silver market. How can silver be tight if the price doesn't always reflect it immediately? This is where weaker analysis collapses, because a lot of people assume one simple rule. If there were really a shortage, the price would already be much higher. That sounds logical, but market structure is rarely that simple, especially in silver. The screen price you see is heavily shaped by paper markets, futures markets, derivative activity, speculative flows, hedging pressure, macro positioning, dollar liquidity, interest rate expectations, algorithmic trading, positioning squeezes, forced liquidations, and margin adjustments. All of that can move price quickly, sometimes violently, and none of it requires an immediate change in the physical condition of the market. That's the key distinction. Paper markets are fast, while physical markets are slower. Paper markets trade claims, while physical markets trade actual metal. Paper markets can react in minutes, while physical markets often reveal stress through premiums, delays, regional spreads, sourcing difficulty, and delivery behavior over time. This doesn't mean paper is fake and physical is the only thing that matters. That's too simplistic. Paper markets matter because they are the reference price, the benchmark that influences hedging, inventory valuation, dealer pricing, and investor psychology. But physical markets matter because they are the final judge. When enough pressure builds underneath, the physical market starts forcing paper assumptions to adjust. Not always immediately and not always cleanly, but eventually distortions create consequences. So let's make this simple. A paper-driven price decline does not automatically mean silver became more abundant. And a paper-driven price rally does not automatically mean the physical market is in shortage. That's why smart money doesn't worship a single signal. It studies the divergence. If spot is down hard but retail premiums stay sticky, that matters. If futures are weak but immediate delivery bids stay firm, that matters. If a decline in price fails to release enough metal into the market, that matters. If inventories trend lower despite periods of price weakness, that matters. If industrial users continue securing supply despite volatility, that matters. What smart money asks is not, what did the chart do today? The better question is, did today's move actually loosen the system? If the answer is no, then the chart may be telling you less than you think. Mechanics can move price without changing fundamentals. We explain why divergence happens. We explain why paper can dominate in the short run while physical wins in the long run. We explain that pricing is not one market. It is a layered market. And the closer stress gets to delivery, settlement, and procurement, the more expensive denial becomes. That's how you build trust. Not by screaming shortage, but by showing viewers how shortages form before the crowd sees them. Now, let's get to the heart of the title. What does smart money see? Smart money is not simply rich money. It is not just institutional money. It is not just hedge funds. Smart money is any capital that understands structure better than the crowd. That includes industrial buyers, sophisticated allocators, producers and refiners, long horizon accumulators, and anyone who knows the difference between price action and market condition. So what do they watch? They watch stress before headlines. They watch frictions before narratives. They watch the markets plumbing because shortages almost always begin in the plumbing. First, they watch inventories, but not lazily and not just total reported inventory. They watch the direction, the composition, the pace, and whether inventories are actually moving into or out of the channels that matter. Second, they watch delivery behavior. How many contracts are standing? How aggressive is nearby demand? Are participants rolling forward casually, or are more players insisting on actual metal? Third, they watch premiums and regional pricing. If retail premiums, wholesale premiums, or regional physical prices stay elevated or recover quickly during paper weakness, that suggests underlying tightness. Fourth, they watch industrial procurement behavior. Are manufacturers relaxed, or are they moving to secure supply earlier than normal? Are they lengthening procurement windows? Are they paying up for certainty? And fifth, they watch sentiment itself. Because one of the strangest things about commodity shortages is that they often begin while sentiment is mixed or even dismissive. Why? Because if everyone already believed in the shortage, the price would likely be much higher already. The best setups often emerge when the market is not fully convinced. That is when smart money gets interested, when the public is distracted by volatility, when headlines are still ambiguous, when the chart looks messy enough to keep weak hands uncertain, when the physical story is getting tighter but the narrative is not yet universal. That's where asymmetry lives, not in certainty, but in the gap between reality and recognition. Now let's get specific. If you take nothing else from this video, take this section, because these are the 5 signals that matter most if you want to judge whether a silver shortage may be forming. Not rumors, not memes, not somebody shouting to the moon, these 5. Signal 1, physical premium behavior. This is one of the cleanest clues. If spot price falls but physical premiums remain stubbornly elevated, that matters. If premiums compress only briefly and then snap back, that matters. If certain products remain hard to source despite weakness on the screen, that matters. Why? Because it suggests the paper market's message is not fully being accepted by the physical chain. A loose market usually behaves loosely. A tight market behaves defensively. And the stronger the divergence between spot weakness and physical firmness, the more careful you should be about trusting the chart alone. When premiums refuse to fully relax in the face of price softness, that's not nothing, that's a clue. Signal 2, inventory trends that reduce cushion. The question is not merely how many ounces exist. The question is the market's cushion growing or shrinking? Is available inventory building comfortably? Or is the system drawing down buffer faster than expected? And just as important, what type of inventory is changing? Eligible and deliverable dynamics matter. Location matters. Velocity matters. If inventory declines over time, while the market narrative stays casual, that's the kind of mismatch smart money notices. Because cushion is what prevents tightness from becoming stress. When cushion shrinks, every additional shock hits harder. Signal 3, delivery behavior. This is where theory gets tested. How many participants are content to roll exposure forward? How many are standing and taking metal? How aggressive is nearby demand? Delivery matters because it forces the market to stop talking in abstractions. When contracts stand, the market moves from price exposure toward show me the metal. Persistent or surprising strength in delivery appetite can tell you that some players care less about paper churn and more about actual possession. That's important. Signal 4, regional price divergence and arbitrage tension. If physical metal in one region consistently commands higher pricing or tighter availability than benchmark futures imply, the market is sending a message. The message is simple. Metal is not equally loose everywhere. And when that happens, arbitrage tries to close the gap. But arbitrage is not magic. It depends on financing, logistics, timing, regulation, and availability. If the gap remains sticky or reappears quickly, that suggests the underlying tightness is not easily solved. This is exactly the kind of thing smart money studies, while the public focuses on headlines. Signal 5, industrial procurement behavior. This may be the least visible to casual investors and one of the most important. Are end users acting calm, or are they beginning to secure supply further ahead? Are they paying more for certainty? Are procurement teams changing behavior? Are buyers becoming less price sensitive and more availability sensitive? That is a major tell. Because industrial users often reveal stress not through dramatic public statements, but through behavior. And behavior in commodity markets speaks louder than commentary. If buyers with real operational needs are acting more defensive, smart money notices. Those 5 signals together give you a much clearer picture than any single chart ever will. And if several of them begin lining up at the same time, the probability of a meaningful tightening event rises significantly. That does not guarantee an immediate explosion in price. But it does tell you the odds of complacency being wrong are increasing. And that is exactly the kind of asymmetry advanced investors look for. Now let's walk through how a silver shortage may form step by step, because once you understand the sequence, the market becomes easier to read. Step 1, demand stays stronger than expected. This doesn't have to mean explosive demand. A shortage doesn't require a stampede on day 1. It can start simply because demand remains persistently firm while analysts expected cooling. Maybe industrial demand stays stronger. Maybe investment demand is quiet but steady. Maybe a major use case keeps drawing ounces without dramatic attention. Step 2, supply response disappoints. This does not have to mean collapse. It can be enough that supply fails to expand when the market wanted relief. Mine output may not respond quickly. Refining bottlenecks may limit throughput. Scrap supply may not come in as anticipated. If demand stays better than expected, while supply stays less responsive than expected, the market tightens. Step 3, inventories begin acting differently. Not necessarily a straight line collapse, but inventories stop feeling abundant. Draws matter more. Rebuilds feel weaker. The market starts leaning on buffer. Step 4, the market tries to fix itself through price, but incompletely. Price rises a bit. People assume that solves everything. But higher prices don't always release enough supply. And if the higher price attracts more investment demand while industrial demand remains sticky, the market can get even tighter instead of looser. That's a classic commodity paradox. Step 5, the spread between paper confidence and physical caution begins widening. Maybe the futures chart consolidates. Maybe speculative longs get flushed. Maybe a margin event hits. Maybe headlines start saying the move is over. And yet, underneath, the physical side does not fully relax. Premiums stay firm. Specific products stay tight. Delivery interest stays elevated. The market is saying the paper panic did not actually solve the physical constraint. That is an important moment. Step 6, confidence starts breaking in one segment of the chain. Perhaps dealers become more careful. Perhaps industrial users begin securing supply further ahead. Perhaps fabricators lengthen lead times. Perhaps vault flows look increasingly one-directional. Shortages don't begin when all confidence breaks. They begin when confidence breaks somewhere important. Step 7, repricing accelerates. The market starts discovering that available ounces are fewer, slower, or more expensive than expected. And when people realize that at the same time, the bid can move quickly, because in tight markets, price does not rise smoothly. It jumps, gaps, and reprices. It forces people to make decisions at worse levels than they could have had earlier. That is why smart money watches before the shortage becomes obvious, because once the shortage becomes obvious, the opportunity usually becomes less attractive. Now here's a point that confuses almost everyone. How can price drops even if shortage risk is increasing? Because markets are not linear, because paper positioning matters, because leverage matters, because liquidity events matter. The developing shortage does not guarantee a smooth uptrend. In fact, some of the most violent downside moves happen precisely because leveraged positions get flushed before the physical story fully reasserts itself. A silver shortage may be forming underneath the surface, and yet paper price can still sell off. Why? Because hedge funds deleverage, because the dollar spikes, because rates shift. because futures longs get shaken out, because traders are forced to liquidate for reasons that have nothing to do with the availability of refined silver in the physical chain. That's why smart money separates signal from liquidation. If price drops and the physical market loosens, that's one thing. If price drops and the physical market does not loosen enough, that's another thing entirely. The second case is where hidden opportunity often lives, because weak hands interpret the lower price as proof the thesis is dead. Strong hands ask a different question. Did lower price actually solve the physical tightness? If no, then the sell-off may be doing more to shake confidence than to fix the problem. And if the problem remains, the market can reprice later, sometimes violently. That is one of the most important lessons in commodities. The path of price is not always the same as the path of fundamentals, especially in the short run, and especially in silver. In shortage-driven markets, confidence is almost as important as inventory. A market functions smoothly not just because metal exists. It functions smoothly because participants trust that metal can be obtained when needed, at a cost that remains manageable. That trust is everything. Once trust begins to crack, behavior changes. Buyers secure supply earlier, sellers become more selective, intermediaries widen margins, procurement teams reduce risk tolerance, and all of that changes the market even before absolute scarcity becomes obvious. A silver shortage may begin not when the last ounce disappears, but when enough participants no longer trust that replacement ounces will be easy to source later. That is a profound shift because market behavior under confidence is very different from market behavior under uncertainty. Under confidence, buyers optimize for price. Under uncertainty, buyers optimize for certainty. When availability is trusted, people negotiate hard. When availability is doubted, people pay up. And once enough participants start paying up for certainty, the benchmark price eventually has to catch up. That is why smart money watches behavior, because behavior reveals confidence, and confidence reveals stress. So what happens next if this shortage risk keeps building? There are several paths. Path 1, the market quietly loosens. Supply improves enough, demand cools enough, inventories stabilize, premiums soften. In that case, the shortage risk remains a scare, not a full event. That is possible. Path 2, the market remains tight, but not broken. Premiums stay sticky, inventories lean down gradually, price trends higher in messy fashion. The market remains uncomfortable but functional. No dramatic headline, just an increasingly tense environment. Path 3, the market enters repricing mode. This happens if enough stress signals line up at once. Physical firmness persists, delivery concern rises, investor demand returns, inventories fail to rebuild, industrial procurement turns more defensive. At that point, the market may start pricing not current scarcity, but expected future scarcity. And that's when moves accelerate. Because once a market starts bidding for tomorrow's shortage instead of today's conditions, price can move much faster than most people expect. Path 4, policy, exchange, or market mechanics create a violent interruption. Even if the structural shortage case strengthens, the path will not necessarily be smooth. There may be margin changes. There may be paper sell-offs. There may be volatility events that shake out weak hands. That's why discipline matters. What matters is understanding the difference between structure and noise. Because in markets like this, it's not just about what happened, but what layer of the system caused it. We explain what layer of the market caused it. That's the macro mirror. Now let's make this practical. If you're watching this market, how do you think clearly without getting emotionally whipped around? First, stop expecting a straight line. If silver shortage risk is building, the path may still be ugly. There may be sharp pullbacks, false breakouts, paper flushes, and narrative reversals. That doesn't automatically invalidate the structure. Second, separate time frame from thesis. What happens today is not necessarily what matters over the next 6 months. A lot of people lose because they confuse tactical turbulence with strategic failure. Third, know what would change your mind. Don't just say, I believe. Say, I believe this, unless these specific signals weaken. That makes your thinking more resilient. Fourth, avoid becoming structurally fragile. If your position can't survive volatility, your analysis may not matter. Fifth, anchor yourself to real signals. Premiums, inventories, delivery behavior, regional divergence, and industrial procurement. Those are better anchors than fear. Now, to be clear, this is education, not personal financial advice. Your risk profile is your risk profile. But from a market structure perspective, one of the biggest mistakes people make is thinking they need to predict every wiggle. You don't. You need to understand what kind of market you are in. A loose market behaves one way. A tightening market behaves another. A shortage-prone market behaves another. If you identify the regime correctly, you are already ahead of most participants. Now, I want to ask you 2 questions. First, when the paper price dips but physical premiums stay firm, which market do you trust more? The screen price or the real-world price people are actually paying? Second, if a silver shortage is forming, do you think the public will recognize it early or only after the repricing has already begun? Put your answer in the comments. And don't just post a one-word answer. Tell me why. Because in this niche, the comments are often a market sentiment map. Let's bring this together. A massive silver shortage may be forming not because of one dramatic headline, not because social media says so, and not because a single day of price action proves it. It may be forming because the structure of the market could be getting tighter beneath the surface, because silver is both a monetary and industrial metal, because supply is not perfectly elastic, because much of silver production is a byproduct, which limits rapid response, because inventories matter not just in size but in accessibility, because the paper market can move independently of physical tightness for a while, because physical premiums, delivery behavior, regional price divergence, inventory trends, and industrial procurement patterns can reveal stress before the public recognizes it. That is what smart money sees. Not certainty, structure, not slogans, signals, not panic, probability. And if the signals continue lining up, the market may eventually have to reprice around a reality that is tighter than the headline narrative currently suggests. That's why this matters. Not because silver shortage is guaranteed, but because complacency may be far more dangerous than people think. So here's the final takeaway. If you only watch the silver chart, you may miss the story. If you only watch the headlines, you may get the story late. But if you watch the structure, the real signals, the real constraints, the real behavior of participants who actually need metal, then you have a chance to see what smart money sees before the crowd does. That's the edge. And that is exactly what we do here on the Macro Mirror. We don't chase noise, we decode it. If you got value from this breakdown, subscribe to the Macro Mirror and turn on notifications. Because in markets like this, timing matters, and by the time the story becomes obvious, it usually isn't early anymore. And now I want your view. Do you believe a genuine silver shortage is beginning to form, or do you think this is just another temporary scare that the market will absorb? Drop your answer in the comments, and if you want, give me the one signal you're watching most closely right now. I read the comments, and the best ones often inspire the next video. Until next time, this is the Macro Mirror. And remember, the headline shows you the move, the macro shows you the mirror.